The S&P was down for a second week in a row, and with the US election taking place next week, as well as the Fed speaking on interest rate cuts, as well as earnings continuing, we expect more volatility right across the board. Now today we're focusing on 6 undervalued dividend stocks at 52-week lows. As always, we'll look at the historical performance, we'll touch upon their earnings quarters from the past and future expectations, we'll touch upon their dividend safety, talk about dividend yield theory, how it helps to spot undervalued companies, as well as take a look at a lot of financial metrics for each one of these 6. And as always, we're going to get to our own valuation. What is our intrinsic value? What is the margin of safety that we see for each one of these stocks? And the upside that Wall Street themselves see over the next year. So jumping in, stock number 1, CVS Health Corporation. We get just one buy rating today from Wall Street with a double hold from Seeking Alpha and Quant. As we can see, trading right there towards its 52-week lows with a nice forward yield, 4.77%, a forward PE, 8.63. For those that are interested, S&P right now trading at a forward P of 25. And over the last 12 months, this company is down 19%. If you've been a long-term shareholder, well, over the last 10 years, you would be down 37%. Bear in mind, it doesn't include dividends reinvested, so you would be up marginally higher. And we can see all-time highs. We're talking the beginning of January 2022. This is more than 2 years ago, $109. Right now, trading less than half that at 56. Now, in terms of their earnings, understand over the next 4 quarters, the next 2, so 50% of them, they're expecting a decrease to the earnings per share year on year. And when we look over the last 4 quarters, they have outperformed on 3 of them, 75% track record, with the more recent one being a nice 10-cent beat. We also note over the next full year, they expect EPS to grow to 7.28, lowering the forward P to 7.7. Then when we take a look at dividend safety, we have an 80 score indicating safety. We see severe undervaluation both on the yield as well as the forward P that we will come to discuss. And they also increased that dividend, very attractive, 9.9% last December, letting us know that next month we are expecting another increase from CVS. Now, it was just reaffirmed a few weeks ago that their dividend is safe, indicating that a dividend cut for this corporation is unlikely. Now, each one we can look at some key metrics. This is from the 07-09 crash. We can see they increased the dividend. They had above average growth, -3%. S&P was around -12, and they also outperformed the S&P, -38, but the S&P 500 itself, -55. As we mentioned, nice increase last December. Over the last 5 years, they've pretty much increased it in line with inflation, 4% year on year. And over the last 20 years, 16% year on year. Very nice to see double-digit growth. However, they only have 2 years of consecutively increasing the dividend. However, they have been paying a dividend without a reduction for the last 27 years. Now, based on the forward P, when we do zoom into over the last 12 months, we can see for the last, we'd say around 6 months, this company has been trading lower than the bottom end of its fair price, indicating severe undervaluation. But remember, we're going to run through each one of these today in our own valuation model. Then we look at dividend yield theory. Now, this tells us a company is undervalued when the current yield sits above the 5-year average. That is a massive difference, so a lot of undervaluation. We can also see the forward P of 8.2 is not only lower than the 5-year rolling of 9.8, but it's significantly lower than the overall healthcare sector at 16.4. Now, bear in mind, some companies do deserve to trade at a discount, like we see with CVS, but we will come to analyze the pure valuation aspect very soon. Now, remember, on this channel, we draw your attention to free cash flow over the earnings, which is susceptible to manipulation by management through accounting. We want below 40% for consumer retailers. That is what we see every year for CVS and expected over the next 12 months. So we are hoping for a very attractive increase to the dividend in December. Then we get to the free cash flow per share, where we want to see increasing consistently year on year. Now, it hasn't quite done that. It is a little bit inconsistent, and we do want to draw your attention. A small drop is anticipated to the free cash flow over the next 12 months. Then we get to the sales growth, where we want 3 to 7% year on year. 3 to 4 is just to keep up in line with inflation. Last few years looking very good. In fact, over the last 10 years, this is a company that does very well on the top line, 7% on a trailing 12 month. And when we do zoom out to look over the last 10 years, it has more than doubled their top line, 139 to 357 reported in the latest annual report. We then move on to shares outstanding, where we want companies to do share buybacks, returning excess cash. We see over the longer term, they have in fact diluted your position as a shareholder, increasing from 1.17 to 1.28, although we have noted over the last year, they have bought back some shares, so hopefully this is something they will do with their capital allocation moving forwards. Always nice for an investor on top of double-digit increases to the dividend. Now ROIC, we want 10% or more, 17 here for consumer retailers. Give us faith, management are able to effectively allocate their capital. Now, it's been very inconsistent over the last 3 years, straddling around that minimum 10% that we want, around 9 to 11%, although we can see a small drop to 7% on the trailing 12 month. Then we get to operating margin. Now, first things first, we want companies that increase top line. We want companies that show us efficiencies, increasing the margin. And whilst we do say above 10% the preference for this industry, when we have reviewed similar companies, we do notice it is around this 5 to 6 percentage point. But the only thing we would say with CVS is that the margins seem to be decreasing, definitely something to consider, and also perhaps an added layer of that margin of safety that we will come to shortly. And we notice free cash flow margin, similar to the operating side, it doesn't quite get to that minimum level we want, and we can see 3% in 2023. We then move on to the net debt to EBITDA, earnings before interest, tax, depreciation, amortization. Below 3 is what we want to see. That isn't really what we get. It does straddle around that, but we do notice 2.94 in 2023, right on the border. Remember, these numbers, number of years it would take the company to pay off all of their debt net of cash on hand. And while we focus on this metric, it correlates to both dividend safety, balance sheet strength. 2.94 expected to go up over the next 12 months. Definitely something to be wary of. We ideally want to see this come down, so a little bit in terms of a cause for concern, but again, as we will now go through the valuation model, we can consider a larger MOS. Now, jumping into the intrinsic value, and as always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Today's intrinsic value of $72 is the average of these three models. Now, when we do our deeper dives, we do run through every single one of these models, the inputs, the outputs, explaining it all. Today, we're going to get straight to it. $72 with the current price. We always start off with a 10% margin of safety, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that today, we'll buy at around $65, then we keep going till it is near the current trading price. And for CVS today, we can see it isn't quite at the 25%, sitting somewhere between 20 to 25%. With Wall Street, their forecast $70, upside of 26%, and remember that yield is nearly touching the 5% point. So is it one to consider? Are you looking to buy, hold, or maybe in fact sell? Give us your thoughts below as we do run through each one. And remember, you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for CVS Health or any others. We also want to let you know we release a free weekly article every single Monday morning where we run through severely undervalued companies that deserve your attention, as well as what's gone on in the week over the last few days. So click on the pinned comment below, you can subscribe and read straight away, and you can also gain access to our 40 undervalued stocks for the month of November. Lots of information for each one, the upside that Wall Street themselves see over the next year as well. And on top of that, you can grab a spreadsheet looking at 22 dividend stocks that Wall Street themselves believe have the most upside in the whole S&P right now over the next year. So click on the pinned comment below, subscribe, and you can read straight away. Moving on, we have Merck Co with 1 buy rating from Wall Street and a double hold. 4.44, so not far off the 4.5 needed to give this a strong buy. As we can see, trading right there towards its 52-week low. A forward yield, again fairly attractive, just above 3%. Forward P just below 13. And over the last year, pretty much flat, down around 1%. Over the last 10 years, it is up around 72%. But as we can see, all-time highs sitting around the $135 mark in 2024. In terms of moving forwards, well, they are expecting growth every single quarter, which is a great sign. And when we do look back over the last 4 quarters, at a bare minimum, they've either been in line or beaten, so nice 100% track record. Large growth expected over the next full year, bringing that forward P down to 10.63. We then have a very safe dividend score of 90, an undervaluation signal or slight reasonable valuation, which we can touch upon, and an increase last year 5.5%, again meaning over the next few days for Merck Co we are expecting an increase. Now what we have noticed, their dividend safety did get downgraded in September, but still at 90 with a very safe score indicates a dividend cut is highly unlikely. Now key metrics, they actually maintained the dividend during the last recession, didn't increase, didn't cut. We also note above average growth, negative 4%, and pretty much a near S&P return, negative 57%. Now, as we mentioned, 5.5 last year, 9% on average over the last 5, with keeping up in line with inflation, 4% over the last 20 years. And whilst they have been increasing those dividends for the last 12 years, they've been paying a dividend for the last 53 without a reduction. Now, when we get into this valuation model and look just over the last 12 months, we can see it is trading around the midpoint or mid to lower of that expected fair value. And when we get to dividend yield theory, we notice very similar, not far off the 5-year average, although the forward P does sit lower than 13.8. That is one sign of undervaluation. Another sign here, healthcare sector as a whole does trade much higher at 16.4. In terms of the free cash flow payout, very inconsistent, although below 60% is what we want. That is what we are expecting over the next 12 months. So, like we said, with the dividend increase anticipated this month, we are expecting this to be at a bare minimum above the inflation, ideally in the high single digit range. Now, free cash flow, very inconsistent, 360 over the more recent year, which was a fall from the previous year, but they're expecting nearly triple the growth over the next 12 months, so looking very good in 2024 expected, and that is shown by the growth in their top line expected on the trailing 12 month at 7%. But when we do look back over the last 10 years, very, very inconsistent, something to consider with Merck Co. From a numerical standpoint though, pretty much doubled their top line from 42 billion to 61 in 2023. Now they've also done some share buybacks, but do take a look, it is very inconsistent. Some years pretty much no movement, so it isn't a priority for the management at the current time. And then we get to ROIC, not only looking very good, 13% in 2014, but it has been increasing over the longer term, nice strong 34% on a trailing 12 month. Then we get to operating margin, where we do get not just above the minimum 12%, but nice operating efficiency. Looks like on a trailing 12 month, very, very strong at 44%. And then when we look at the free cash flow margin, even though it has been very inconsistent, still looking above the minimum and very strong, 21% on a trailing 12 month. And then we get the net debt to EBITDA. Whilst we do want it below 3, it is marginally lower in 2023, but expected as well as the trailing 12 month to come down very sharply. And that is why we still get that very safe dividend score of 90, and therefore the balance sheet does look to be in good shape. Now, our intrinsic value of $146 will in effect give a very large margin of safety in today's episode. As we can see, and we keep going, at the 30% point is where we see MRK right now, with Wall Street, as we said, on the borderline of a strong buy for them. They have a $138 price target, where they see 35% upside just over the next 12 months. As always, do give us your thoughts about each one of these below. We then move on to the Hershey company with a triple hold right across the board. This is trading at its 52-week low, with a yield again similar to Merck Co, just above 3%, a forward P just above 19. Over the last year, it is down 5% and has been coming down. Just over the last week, it is down 2.21%. Over the last 10 years, though, it is up 86%. As we can see, has been coming down from pretty much a year and a half ago at $275. Now, over the next 4 quarters, 2 of them, they are expecting a decrease to the EPS, and their more recent earnings, there was a substantial miss, so therefore a 75% track record. And also bear in mind, for the next full year, earnings per share for Hershey is anticipated to come down, therefore increasing that forward P to 19.9. Now, we do have a safe dividend score with massive double undervaluation, and we can see just this year they increased that dividend by 15%, always like to see. And in terms of the last recession, while they maintained the dividend, they had pretty much flat growth, so above average of negative 12, and they also massively outperformed the S&P, negative 30%. As we said, this is a company that does grow their dividend on a continual basis at the double-digit rate, 10% year on year over the last 20 years. And whilst you see 14 years of increasing the dividend, they've been paying a dividend for the last 94 years without a reduction. Then we get to the forward P basis, and pretty much for the last year they have been trading at severe undervaluation, and it does look the same case right now as well. On top of that, when we look at dividend yield theory as well as the forward PE, a double undervaluation. The yield is around 3% above the 5-year of 2, and the forward PE 19.5 above the 5-year of 24. We do, however, note it is marginally higher than consumer staples as a whole at 18.2. In terms of the free cash flow payout, well, below 70% for consumer staples, pretty much there for the majority of the last 10 years, 60% over the next 12 months expected. And in terms of free cash flow, it has been increasing nearly fourfold over the last 10 years, expected to continue again over the next 12 months to $9.10. And when we look at it from a sales growth, very, very inconsistent. In fact, whilst the last 3 years have been good, bear in mind on a trailing 12-month, we are seeing limited growth to the upside of around 1%. In terms of numerical as well, whilst it has grown by around 50%, we do notice many, many years where it has been fairly stagnant. And in terms of shares outstanding, they have bought back around 10% over the last 10 years, but very trivial amounts year on year, not something, again, that they do seem to prioritize. In terms of ROIC, whilst it has decreased over the longer term, from 2018 in the mid-20s, looking very healthy, very consistent as well, 26% on a trailing 12-month basis. And then we get to the margins. Operating side, minimal operating efficiency, but good to see above the minimums. And the free cash flow margin, pretty much the same to be said there as well. 13% on a trailing 12-month is still very good to know. Then we get to the net debt to EBITDA, consistently below 4, which is the maximum for consumer staples. 1.49 in 23, 1.78 over the next 12 months. So again, absolutely no worries with their balance sheet and their dividend safety with this information. Now, our intrinsic value of $211 is higher than Wall Street. Their price target, $200, upside of 12%. Remember, we did see a triple hold right across the board. In terms of MOS, well, 10% a buy at 190, at 15%, pretty much where we see this company now. Bear in mind, it hasn't had the greatest last few years. The prices have been coming down. Cocoa prices were increasing, putting a lot of pressure on their margins, and whether or not this is something that is in the rearview mirror or is going to be a continued issue over the next few years, definitely something to consider. But as we said, 15% MOS, 12% upside. Give us your thoughts below. We then move on to Nestlé with a double buy signal and a hold from quant, trading at its 52-week low with a forward yield of 3.5%, a forward PE just below 18. Over the last year, it's been struggling down 13%. Over the last 10 years, it is up only 30%, as we can see here, pretty much all-time high at the back end of 2021, around $140. Now, what we do notice here, their earnings per share is pretty much expected to be fairly flat over the next full year, although we are anticipating very minimal growth to their revenue from 24 to 25, so not massive amounts of growth on either EPS or their top line. Nonetheless, dividend safety score 90, very safe, another severe undervaluation score on both models, and we can in fact see dividend growth very trivial, very slow, 1.7% in February this year. Now, it was just downgraded, their dividend safety score, a few days ago, but again, we can still see very safe. It does indicate a dividend cut is highly unlikely. Now, last recession, they increased the dividend, and they pretty much had bang on average growth at negative 12.5%. Now, dividend increase pretty much in line with inflation over the last 5 years, and around 7% over the last 20, with 23 years of continually increasing the dividend. 2 more years, and they will become an official dividend aristocrat. So let's take a look at this valuation model over the last year, pretty much for the whole point of the last 12 months, in fact, although getting more and more undervalued as time goes on, so definitely something to bear in mind. But we also see this, in fact, reflected on that dividend yield, currently at 3.6%, significantly higher than the 5-year rolling of 2.54. Then we move on to the free cash flow payout, where we do in fact see straddling above the maximum we want to see, 82% in 23, expected to come down to 77, but still a little bit too high for what we want, so do consider an added level of margin of safety. Then we look at the free cash flow, very inconsistent and in fact minimal growth over the last 10 years, minimal growth again expected over the next 12 months. And when we look at their top line, in fact this isn't really what we want to see. 4 of the last 10 years have been negative growth, including 2023. Therefore, when we do zoom out, we can in fact see when we look at 2014's position to 2023, their top line probably, you could argue with a lot of confidence, hasn't been keeping up in line with inflation. Therefore, real terms has been decreasing. Shares outstanding, this is nice though. They have been buying back quite aggressively a lot of shares over the last 10 years. In fact, around 600 as we can see here, and 20 million. We then move on to the ROIC. Always good to see consistency above the 12% in the mid to upper teens, 15% on a trailing 12-month. Margins very, very consistent. In fact, pretty much 16 to 17% every single year. Free cash flow as well, not looking bad, above the 7%, 12% on a purely trailing 12-month basis. Then we get to the net debt to EBITDA, where we want to see below 4, similar to the target for Hershey. And this is probably the one metric we don't want to see increasing that we have. And it looks like on a trailing 12-month and over the next 12 months, they are taking on a lot more debt. Definitely something to consider. As we said, we don't want to get this out of control, but it is still below 4. Again, just a point to consider. In terms of the intrinsic value, well, 114, again, pretty much similar to Wall Street, 114, where they see 20% upside over the next 12 months. When we look at margin of safety, well, 10% a buy at 102, 15% at $97, at 20%, not quite there yet. So for Nestlé today, around 15 to 20% MOS with 20% upside from Wall Street and their expectations. And let us know maybe if this one is on your radar, on your watch list, or for whatever reason it doesn't fit your overall portfolio. We then move on to the luxury brands conglomerate LVMH. Now we get a buy rating from Seeking Alpha, trading towards its 52-week lows with one of the lower yields today at 1.81%. And we can see over the last 12 months down 8%. Over the last 10 years though, it has massively outperformed the S&P, up nearly 300%, although we can see all-time highs around last summer at $1,000. Now in terms of their growth, they're expecting their revenue to increase by around 5% over the next 12 months. Lots of issues to consider around China as well, as we've seen from the reporting of Estee Lauder. That has really hurt their top line. In terms of growth for LVMH, up around 8% over the last full year, and we can see this is a company that does continually increase their dividend at a fairly attractive rate to shareholders. And then when we look at their financials, what we can see, free cash flow payout 61% in 2023, pretty much on that borderline of the 60% we want, and 54% on a trailing 12 month. Now free cash flow has been growing at a very attractive rate over the last 10 years, but we have to point out from the highs of 2021, it has started to come down. Nice to see over the next 12 months though, growth is anticipated to just under $30 per share. No surprises for the COVID drop of negative 17%, but bar that, we are seeing some strong growth year on year. We can see though on the trailing 12 month only 1%, and we don't expect 2024 to be a particularly good year for this company. Nonetheless, their top line has nearly tripled over the last 10 years, and very obvious to see, buying back shares isn't something management do consider at all, given it has been fairly flat for the last 10. ROIC looking consistently good around the 16 to 21% over the last few years. No worries whatsoever with management and that aspect. And then we get to the operating margin, where we see some efficiencies, a little bit inconsistent, but still looking very good, above the minimum 16%. Same to be said here for the free cash flow, above the 5% and looking very healthy even after the drop down to 12%. In fact, we see 14 on a trailing 12-month basis. Now, net debt to EBITDA has been consistently below 3, down from the all-time highs of 2014's 2.9, 1.67 in 23, 1.82 over the next 12 months, so nothing really to consider or any red flag indicators with respect to that. Now, our intrinsic value, $884, when we do put it through the MOS at 10%, a buy at 796, at 20% around 707, at 25%, pretty much where we see the current price right now. So 25% margin of safety. Do understand though, Wall Street have been lowering their forecast gradually, now at 795, but they still see 21% upside. And remember, a lot of the bearish sentiment here is around China, how much that has affected pretty much a lot of companies in a similar industry. So lots to consider. Nice MOS, nice upside, but again, do factor in how the last year has gone. We then move on to the rail company, Canadian National Railway, with one buy from Seeking Alpha, a double hold from Wall Street and Quant, trading at its 52-week low, a forward yield of 2.24%, a forward PE of 20.5, and we can see over the last 12 months pretty much flat, over the last 10 years up 56%. Now, in terms of moving forwards, they are expecting growth every single quarter, but they have missed one, so 75% track record. Nice to see, though, the more recent quarter was a marginal beat. And with growth expected into December 2025, forward P is anticipated 18.2. Dividend safety, great to see, very safe. Also severe undervaluation again, with a nice 7% increase to the dividend in January this year. Now, when we take a look at the key metrics, they increased the dividend, they had average growth, whilst also marginally outperforming the S&P. Dividend growth, though, 12% over the last 5, 16 over the last 20, so it is very common for them to increase it by a double-digit rate, and they're also a dividend aristocrat with more than 25 years of continually increasing the dividend. So when we take a look at this valuation model, over the last 12 months, it's pretty much been trading towards the lower end of the fair price. Right now, though, we're seeing it below even the lower end, signaling some severe undervaluation. This is also backed up by the fact that dividend yield theory, we can see here 2.26 above 1.88, as well as the forward P of 18.6, one of the lowest it has been, in fact, if we do exclude the COVID drop, so it could signal a potential great buying opportunity, and it is also lower than the industrial sector at 19.9. In terms of the free cash flow payout, again, pretty much below 60% every single year, although it is anticipated around 61 over the next 12 months. Nonetheless, we are anticipating another high single-digit increase to the dividend in January 25. Free cash flow as well, we do notice it has pretty much doubled over the last 10 years, although a minimal drop over the next 12 months. But understand, this company isn't a tech company. We're not expected to see fast-growing numbers, and it is fairly cyclical, which is shown through the top-line revenue. 3 of the last 10 years, including 2023, has been negative. Trailing 12-month, though, showing a sign of positive into the new year. Then when we look at it from a numerical perspective, we can see around 40% growth from 12 billion to 17. And one thing we do like, they do seem to be continuing buying back shares. We expect, given the price right now, this is something they will continue to do, as the company does look to be in a good undervaluation. Then we get to ROIC, looking very strong, consistently around the mid-teens, something we always like. Consistency is something we've said before that we do sometimes pay a bit of a premium for. And the margins looking very strong in the mid-40s year on year. Free cash flow margin as well, looking very good. And remember, this industry, there are high barriers to entry, so it would be very difficult for a new competitor to come and take away any of their market share. Net debt to EBITDA below 3, 2.16 in 2023, 2.29 over the next 12 months. Still lower than the maximum, maybe something to keep an eye on. But when we do get to essentially our intrinsic value, we can see Wall Street themselves give this a $128 price target with 19% upside. When we look at our intrinsic value, on the other hand, $133, a little bit higher, and we put it through the MOS, 10%, a buy at 119, at 20%, not there yet, but not that far off. So you could say Canadian National Railway Company has a near 20% MOS with 19% upside over the next year at $128. Definitely one that I will be considering. It is already in my portfolio, and probably one that over the next few weeks I will be re-adding. As always though, do give us your thoughts in the comments below. If you've enjoyed today's episode, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Don't forget, you can grab a copy of this model by clicking on the pinned comment below, where you can also subscribe to our free weekly newsletter. Next one is dropping tomorrow morning, and also joining us in the Patreon, where we do talk about our weekly buys and sells. As always, have a great day, and we'll see you all on the next one.